Just 2 weeks ago, mortgage rates did something they hadn't done since 2022. They dropped below 6%. Buyers who had been sitting on the sidelines for 4 years finally felt like they had a window. Lenders were buzzing. Spring was shaping up to be the best home buying season in years. And then, war broke out. On February 28, 2026, the United States attacked Iran. And within days, mortgage rates reversed course. Oil prices surged past $100 a barrel for the first time since the Russia-Ukraine war, and the spring home buying season, the most important buying window of the year, was suddenly in serious jeopardy. So here's the question every buyer, seller, investor, and renter needs answered right now. Is this a temporary blip, or is the housing market about to get significantly worse before it gets better? Stay with me, because by the end of this video, you will know exactly what is happening, what the data says, and what move you need to make right now. If you're serious about understanding what's really driving the housing market, hit subscribe right now and turn on notifications. We break down real estate data every single week so you never get caught off guard. Welcome back to the channel. If you're new here, this is where we cut through the noise, strip away the headlines, and give you real data-backed analysis on the housing market. Whether you're a first-time buyer, a landlord, a retiree trying to downsize, or someone just trying to figure out if renting still makes sense, this channel is built for you. Now, today's video is based on a report published by Housing Wire, one of the most respected real estate data outlets in the country, and it paints a very specific, very urgent picture of what is happening to mortgage rates right now because of the U.S.-Iran conflict. Here's why this matters to you. Right now, in March 2026, spring is the hottest home buying season of the year. Buyers are active. Sellers are listing. It's the moment the housing market either comes alive or stalls out. And for the first time in a long time, we had genuine momentum. Rates were falling. Demand was rising. Inventory was ticking up. Everything was pointing to a strong spring. That momentum is now at serious risk. Let's get into it. How one military strike reversed 4 years of progress on mortgage affordability. Let's start with the timeline, because context matters here. For most of 2024 and 2025, American homebuyers were locked out of the market. Mortgage rates hovered between 6.5% and 7%. Home prices stayed stubbornly high, and inventory was painfully thin. The affordability crisis was real, and it was grinding. Then, in late 2025, something shifted. The 10-year Treasury yield, which is the key benchmark that mortgage rates follow, started falling. By the end of 2025, it had settled into a calm range between 4% and 4.3%. And that calm trickled down to buyers. Freddie Mac's weekly report showed the average 30-year fixed mortgage rate dipped to 5.98% on February 26th, a level buyers hadn't seen since 2022. Then, on February 28th, the U.S. attacked Iran, and everything reversed. Mortgage rates and the 10-year Treasury yield rose in lockstep with oil prices since the start of the war. The price per barrel of oil rose to a high of $119.48 on March 9th. The yield on 10-year Treasuries climbed from 3.96% on February 27th to 4.21% on March 11th. And average mortgage rates jumped from 5.99% on February 27th to 6.19% on March 11th. Mortgage News Daily reported that 30-year fixed rates spiked to a 7-month high of 6.41% before retreating to 6.36% by the following Tuesday. That's nearly half a percentage point increase in under 2 weeks. On a $350,000 home loan, that difference alone adds roughly $100 to your monthly payment. That's over $1,200 a year, just from a 2-week rate spike. 2. Why war in Iran moves mortgage rates in America. This is the part most news outlets skip. They tell you rates went up, but they don't tell you why war in a distant country affects the interest rate on your home loan. Let's fix that. Here's the chain. Step 1. Oil prices rise. Iran controls access to the Strait of Hormuz, one of the world's most critical oil shipping routes. When conflict escalates in that region, global oil markets panic and crude oil prices spike. The price of crude oil opened at $71.23 per barrel on March 2nd and surged to an opening price of $115.53 by March 9th. The first time oil passed $100 since Russia invaded Ukraine in 2022. Step 2. Inflation expectations rise. A prolonged war with Iran could push oil prices higher and revive inflation concerns, prompting investors to sell bonds, sending Treasury yields higher, which would likely push up mortgage rates as well. Higher oil means higher gas. Higher gas means higher transportation costs. Higher transportation means more expensive food, goods, and services. That's embedded inflation, and it's the kind that makes the Federal Reserve nervous. Step 3. The Fed shifts posture. Even some doves at the Federal Reserve turned hawkish this week. Fed Governor Christopher Waller took a hawkish stance in a CNBC interview, adding to the bond market's move higher. Markets are now pricing a 50% chance of a rate hike in October. Let that sink in. Just weeks ago, the market was expecting rate cuts. Now it's pricing in rate hikes. Step 4. Mortgage rates follow. Rates not only breached 6.25%, but ended the week at 6.41% on Friday as mortgage spreads worsened, flipping the low volatility story of 2026. This is a full-chain reaction, from a military strike in the Middle East to a higher monthly payment on your mortgage application. It sounds abstract, but it is completely real. 3. Is the market holding up, or are buyers already walking away? Here's where it gets nuanced, because not everything is collapsing. The data is actually more mixed than the headlines suggest, and you need to understand both sides. The positive signals. MBA President Bob Brooksmith stated that mortgage applications have increased for 3 consecutive weeks as borrowers continue to take advantage of rates around 6%. Despite ongoing geopolitical tensions, overall demand remains strong, with applications to both refinance and buy a home running far above year-ago levels. The housing market is poised for growth in 2026. Existing home sales rose in February. Purchase application data has been positive year-over-year every week in 2026, and the weekly housing market tracker shows positive pending sales year-over-year. That's genuinely encouraging. It tells us that buyers haven't panicked yet. They're still active. They're still in the market. But here's the warning. As in previous years, whenever mortgage rates spike towards 7% or higher, the demand curve fades. And we don't really see any movement in home sales for the calendar year until rates fall again. That's the cliff edge. 7% is the number. Right now, rates are at 6.36% to 6.41%, depending on the source. We are not far from that threshold, and with the conflict still escalating, that number is in play. 4. So what happens if the war drags on? This is the section that separates casual observers from people who are truly prepared, because there's a big difference between a short, contained conflict and a prolonged war, and the housing market reacts very differently to each. The high end of the mortgage rate forecast is now easily in play at 6.50% to 6.75%. At the beginning of this conflict, analysts said that if it continued past March 21st, the economic outlook would need to be reassessed as the impacts become more painful the longer it goes, with higher rates and higher oil prices. If this conflict continues and worsens, bond yields will rise and more rate hikes will be priced in. The bond market has now priced out all rate cuts and is pricing in a rate hike in 2026. Now here is something concrete. Oil rose as high as $92 last week and could go even higher. The prior week saw a 41.6 cent per gallon increase in gas prices, among the top 10 biggest weekly gas price increases in history. And when oil gets expensive, it's not just your gas tank that hurts. It's the cost of building homes, materials, freight, labor, the cost of running real estate businesses, and ultimately, the cost of buying and owning property. With oil as a central tenet of this war, it has the potential to raise supply chain costs or cause delays in the chain altogether. The scenario no one wants to say out loud. If this conflict is still active by late spring, we could be looking at a housing market that essentially freezes. Not crashes, freezes. Sellers won't want to cut prices. Buyers won't be able to afford the payments. And the standoff that defined 2023 and 2024 could be back, just with a military conflict as the backdrop instead of post-pandemic inflation. The bigger picture is, was affordability already broken before the war? Here's the thing. The Iran conflict didn't create the housing affordability crisis. It just kicked it while it was trying to stand back up. For years, the combination of elevated mortgage rates, rising home prices, and a persistent housing shortage have shut out many Americans from the housing market. Home prices have stayed high, but lower rates in recent months had helped lure some buyers off the sidelines, with existing home sales rising 1.7% in February, according to the National Association of Realtors. That recovery was fragile. One external shock was all it took to put it back on pause. According to the National Association of Realtors, Lawrence Yun, NAR's chief economist, noted that spring is when more buyers are kicking the tires, visiting open houses, and the outlook for the spring home buying season has become cloudier than it was even just a month ago. Lisa Sturtevant, chief economist at Bright MLS, put it plainly. If the conflict with Iran is limited, the housing market could rebound quickly. However, a prolonged conflict could stall home sales activity this spring. That's not a fringe opinion. That's the consensus view from top housing economists right now. Here is one move that separates smart buyers from regretful ones right now. Let me be direct here. If you're a buyer who was planning to move this spring, this is not the moment to panic. But it is the moment to be strategic. Here's the honest breakdown. The warning. The velocity of the rate move begs the question of what will happen next. Rates are at their yearly high, and mortgage spreads have worsened. If rates breach 7% and stay there, the window that cracked open at the end of February will slam shut again. First-time buyers will be the hardest hit. If your pre-approval was calculated at 6%, a move to 6.75% to 7% could knock you out of your target price range entirely. The opportunity, despite the conflict abroad, rates are likely to remain much lower than they were a year ago, when the average was 6.63%. The baseline has improved, even if recent events have pushed rates up from the floor. And here's the strategic play. The best strategy for mortgages this year is to lock in your rate at the right moment. If you see rates reach a low point, call your mortgage lender to secure the rate. If rates spike, wait a bit before cementing your rate. That means watching the news closely. If the conflict cools and oil prices stabilize, there could be a secondary dip in rates before summer. That is your window. Don't chase rates. Position yourself in advance and be ready to act fast. Drop a comment below. Are you currently trying to buy, or are you holding off because of what's happening with rates? I read every comment, and it genuinely shapes what we cover next. For investors, this isn't the moment to exit. Rental demand does not slow during uncertainty, it actually accelerates. When buyers are priced out or hesitant, they rent. If rates stay elevated through summer, rental demand could tick up in the exact markets where purchase activity slows. That's your window if you're a landlord or considering your first investment property. Let me pull this all together for you. Here's what we know. 1. Mortgage rates dropped to 5.98% on February 26th, the first time below 6% since 2022, and then the U.S. attacked Iran 2 days later. That window is now closed for the moment. 2. 30-year conforming rates are currently averaging 6.19% at HousingWire's Mortgage Rates Center, with some lenders quoting as high as 6.41%. 3. The escalation risk is real. The bond market has priced out all rate cuts and is now pricing in a rate hike. And if the conflict continues and worsens, bond yields and mortgage rates could go higher still. 4. Demand is still holding. For now, purchase application data has been positive year over year every single week in 2026. Buyers haven't walked away yet, but the line between cautious buyers and frozen market is razor thin at this rate level. 5. The critical number to watch is 7%. That is the level at which, historically, housing market activity stalls. We are currently 60 basis points away. Stay watching. The bottom line? The spring season that looked so promising in late February is now on life support. Not dead, but on a ventilator. The next 2 to 4 weeks of the Iran conflict will likely determine whether 2026 becomes a year of recovery or a year of continued stagnation for American homebuyers. And that is exactly what I'll be tracking on this channel every single week. So here's my question for you before you go. If rates hit 7% this spring, would you still buy, or would you wait it out? Tell me in the comments. Seriously, I want to know. If this video helped you understand what's actually happening in the housing market right now, subscribe. We post real estate data breakdowns every week. No fluff, no hype. Just the information you need to make smart decisions. And comment on the city or town you want us to analyze next. I pick one every week. Until next time, stay informed, stay strategic, and keep building.